Most people have no idea what their credit score is actually costing them every single month, not in vague terms, in real dollars. Dollars leaving your bank account every month because of a 3-digit number most people have never seriously thought about. By the end of this video, you are going to know exactly how much your credit score is costing you right now across your mortgage, your car loan, your credit cards, and your insurance. And more importantly, you're going to know the fastest legal ways to move that number, some of which can work within a single billing cycle. Let us start with the basics. Your credit score is a number between 300 and 850. It is calculated by companies like FICO and VantageScore based on your financial behavior. And it is the single most important number in your financial life that most people treat like an afterthought. Here is how the ranges break down. 800 to 850 is exceptional. 740 to 799 is very good. 670 to 739 is good. 580 to 669 is fair. And anything below 580 is poor. The national average FICO score heading into 2026 was 715. That means the average American is sitting in the good range. But good is not the same as great. And the difference between good and great is measured in tens of thousands of dollars over your lifetime. Here is the math nobody shows you. Let us walk through 4 areas of your financial life and calculate exactly what your credit score is costing you. Area number 1, your mortgage. This is where your credit score does the most damage or delivers the most savings. Let us use a real example. You want to buy a $350,000 home. You put 10% down, leaving a loan balance of $315,000 on a 30-year fixed-rate mortgage. If your credit score is 760 or above, current data from Experian and Curinos puts your rate at around 6.15%. Your monthly payment is approximately $1,918. Total interest, paid over 30 years, around $375,000. Now let us say your credit score is 660. Same house, same loan amount, same bank. Your rate jumps to approximately 7.10%. Your monthly payment rises to around $2,109. Total interest, paid over 30 years, approximately $444,000. The difference in monthly payment is $191. That sounds manageable, but multiply that by 360 months. That is $68,760 in additional interest for the same house. Because of a 100-point difference in a credit score, and if your score is below 620, you may not qualify for a conventional loan at all. You would be pushed into FHA loans or higher rate products that cost even more. Area number 2, your car loan. Most people focus on the price of the car. The smarter question is, what interest rate am I paying on that price? According to Experian data from Q4 2025, a buyer with excellent credit securing a new car loan pays an average rate of 4.66%. A buyer with poor credit pays an average rate of 16.01%. Let us run the math on a $35,000 car with a 60-month loan. At 4.66%, your monthly payment is approximately $653. Total interest paid, around $4,180. At 16.01%, your monthly payment jumps to approximately $851. Total interest paid, around $16,060. That is $11,880 more in interest for the same car. And that difference in monthly payment, $198, is money that could be invested, saved, or used to pay down other debt every single month for 5 years. Your credit score is not just a number. It is a monthly tax on your lifestyle. Area number 3, your credit cards. Credit card interest rates are where poor credit does its most immediate damage. The average credit card interest rate in 2026 sits around 21%. But for borrowers with poor credit, rates on new cards can reach 28 to 30% or higher. If you carry a balance of $5,000 on a credit card at 21% interest and make only minimum payments, you will pay approximately $5,270 in interest alone. That means you pay more than double the original balance. At 29% interest on that same $5,000 balance, you pay approximately $9,400 in interest, nearly triple the original amount. And the brutal reality is that people with poor credit, who most need access to credit, end up paying the most to use it. That cycle is exactly what this video is designed to help you break. Area number 4, your insurance. This one surprises most people. Your credit score affects your car insurance premium in most states. Drivers with poor credit pay 40 to 115% more for auto insurance than those with excellent credit. That translates to an extra $800 to $2,000 per year in most markets. So if you are paying $1,800 per year for car insurance with poor credit, someone with excellent credit driving the same car in the same zip code might be paying $900. That is $900 a year, or $75 a month, gone because of a credit score. The total cost summary. Let us add it all up for a person with fair credit versus excellent credit over 10 years. Mortgage premium, approximately $22,920 in extra interest over 10 years. Car loan premium, approximately $11,880 in extra interest over the life of one loan. Credit card premium, assuming one carried balance, approximately $4,000 to $9,000 in extra interest. Insurance premium, approximately $7,500 to $20,000 in extra premiums over 10 years. Total extra cost of having fair versus excellent credit over 10 years, conservatively between $46,000 and $63,000. That is not a hypothetical. That is the real financial cost of an ignored credit score. Now that you know what it is costing you, let us talk about how to fix it. Here is how your FICO score is actually calculated. 35% is payment history. 30% is credit utilization. 15% is length of credit history. 10% is credit mix. 10% is new credit inquiries. Payment history and credit utilization make up 65% of your score. That means fixing those two things moves the needle faster than anything else. How to improve your score fast. Strategy number 1. Pay down your credit card balances below 30% utilization. This is the single fastest legal way to raise your credit score. Credit utilization has no memory. If you have a $10,000 credit limit and a $7,000 balance, your utilization is 70%. That is crushing your score right now. Pay it down to $3,000 and your utilization drops to 30%. Pay it to $1,000 and your utilization is 10%. People with 800 plus scores typically keep their utilization below 7%. The FICO scoring model updates the moment your new balance is reported, which happens when your statement closes each month. That means you can see a score increase in as little as 30 days. Strategy number 2. Dispute errors on your credit report. A 2023 Consumer Financial Protection Bureau study found that 1 in 5 consumers had a verified error on at least one credit report. Late payments reported on the wrong date, collections for debts that were already paid, accounts that do not belong to you. Every one of those errors is actively dragging your score down right now. You are entitled by law to a free copy of all 3 credit reports every year at annualcreditreport.com. Pull all 3 reports today and look for anything that is inaccurate. Dispute any errors directly with the credit bureaus online. Corrections typically take 30 to 45 days. And if a late payment or collection is removed from your report, the score impact can be significant. Strategy number 3. Never miss a payment. Payment history is 35% of your score. A single late payment can drop your score by 60 to 110 points, and it stays on your report for 7 years. Set every bill to auto-pay for at least the minimum amount due. You never want a late payment to hit your report because you forgot. Strategy number 4. Do not close old credit cards. This surprises most people. Closing a credit card you no longer use actually hurts your score. It reduces your total available credit, which raises your utilization ratio, and it shortens your average account age, which hurts the length of credit history portion of your score. If you have an old card with no annual fee, keep it open. Put a small recurring charge on it, like a streaming subscription, and set it to autopay. That keeps the account active and your utilization low. Strategy number 5, request a credit limit increase. If you have been with a credit card company for at least 12 months and have a solid payment history, call them and request a credit limit increase. If your limit goes from $5,000 to $10,000 and your balance stays the same, your utilization just dropped in half. That alone can move your score meaningfully without you changing your spending at all. Strategy number 6, become an authorized user on someone else's account. If a family member or trusted friend has a credit card with a long history, high limit, and perfect payment record, ask them to add you as an authorized user. You do not even need to use the card. Their positive history gets added to your credit file and can boost your score relatively quickly. Strategy number 7, use a credit builder loan if you are starting from scratch. If you have thin credit or no credit history, a credit builder loan from a credit union or company like Self is one of the most efficient ways to establish a positive payment history. These loans are specifically designed to build credit. You make monthly payments, and at the end of the term, you receive the money. It costs you relatively little and adds months of on-time payment history to your report. The credit score improvement timeline. Here is what a realistic improvement timeline looks like. Within 30 days, paying down your credit card utilization can move your score 20 to 50 points. Within 60 to 90 days, disputing and correcting errors on your report can add another 10 to 40 points, depending on what is removed. Within 6 months, consistent on-time payments and low utilization can move a fair score into the good range. Within 12 to 18 months, a good score can become very good with disciplined behavior. And within 2 to 3 years, most people who follow these strategies consistently can reach the 760+ tier where lenders offer their best rates. The action plan for this week. Step 1. Go to annualcreditreport.com and pull all 3 of your credit reports for free. Step 2. Check your credit card balances and calculate your current utilization on each card. Step 3. If any card is above 30% utilization, make a plan to pay it below that threshold as your first financial priority. Step 4. Look for any errors on your report and file disputes for anything inaccurate. Step 5. Set every bill to autopay for at least the minimum payment due. These 5 steps cost you nothing except time, and the payoff, as we showed at the beginning of this video, could be $50,000 or more over the next decade. That is not a small number. That is a car. That is a down payment on a house. That is a child's education fund, all sitting in your credit score, waiting to be unlocked. If this video gave you something useful, hit subscribe. Every week on the Compound Brief, we break down money, careers, real estate, and business in plain English. No fluff, no gatekeeping. Next week, we are covering how to buy your first home with $10,000 or less. And yes, the math actually works. That video drops next week. See you then.